Welcome to the Killik & Co weekly podcast. It's the 8th of September. Well, last week was a pretty dramatic week for stock markets, currency markets in particular, and this came on the back of a combination of data points and speeches, most notably the ECB that has cut interest rates and deposits rates across the board, and also putting in place plans for a further QE style support to the European economies, and that had a fairly dramatic impact on the value of the euro, which we'll go on to shortly. So end of last week, non-farm payroll numbers in the US slightly on the disappointing side. Headline number of maybe 200,000 new jobs created was missed, and the number came through at just over 140,000. So we're still very much each week thinking about US interest rate increases, the UK, when will we start to push interest rates up here, and in Europe, how low can they go and how far will they go to support the European economies? This week, well, it should be on paper a tamer market. Just starting off on tomorrow, Bank of Japan minutes. Interesting to note that when they introduced the tax in April, the VAT equivalent in Japan, it appears that that had a more meaningful negative impact on the economy than first thought. So interesting to see those minutes, but we are looking increasingly at breakouts in Japanese asset prices at the moment. Produced a note on that last week. So still favourably disposed towards Japan at the moment. It is climbing a wall of fear out there at the moment. Just turning to some of the sort of corporate results that are coming out this week. William Morrison in the supermarkets laid down the gauntlet a little bit last week by talking about dividend hikes going forward. It seemed to be a very brave call. I think left some of their major shareholders slightly nervous about strategy. This comes in light, of course, of Tesco cutting their dividend by 75% over time. So maybe it's just a touch of bravado there against a competitor, and whether it's the wisest thing to do, well, maybe we'll hear more about that on Wednesday. Also on that day, well, one of the biggest companies, or most successful companies in the retail space, Next, is reporting. And interesting to note, last week Super Group had a much more encouraging trading period in the last 3 to 4 weeks. The slightly cooler weather that was seen in the UK has encouraged people back into the stores, starting to stock up a little bit on some of the warmer clothing, and a little bit earlier in the year. It's always an important transition for the retailers, and one that Next has managed to navigate its way around quite successfully over the course of the last few years. So again, be interesting to take a look at Next at that point. So let's take a look at some of the charts that were of interest last week, and really it is currencies that play a meaningful impact at the moment. Really since Mario Draghi was discussing back in the early part of the summer about the high value of the euro and really making a move towards lowering the value of the euro. He's had a great deal of success with that, much with just words alone, but the actions came last week, and you can see the very sharp drop in the euro. So it's fair to say that the market had a pretty strong heads up as to there could be action coming from Mario Draghi last week. It would have been no surprise, given that he was speaking at Jackson Hole just a week earlier at the conference there with the US Fed Chair Janet Yellen. And so you would have thought that the market had got itself into a position in readiness for some support, but he managed to even surprise them by going further than expected. That caused a drop in the euro, and again, weekend press comment suggesting that they don't want to sort of hold back on this. They want to continue driving policy at the moment with the objective of weakening the euro and assisting very much in European economies being able to trade their way out through exports at the moment. So that's a fairly material feature at the moment for it, and certainly keeping stock markets alive to the excitement of the engineering that's taking place within the ECB at the moment. It's not a dissimilar story for the pound. The pound has been weakening since really the end of July, touching 172 against the dollar. Really, dollar strength has played its part here. The dollar has been quite strong against the euro. But nevertheless, we've now seen a nigh on 7% decline since late July of the value of sterling. That will provide much pleasing news, of course, to many of our big corporations that have in the past been complaining about the high value of sterling and the translation impact back onto corporate results. Companies like WPP, for example, that have been posting double-digit underlying growth are reporting very flat earnings. So this is going to come as pretty much a welcome relief to many businesses. Makes going on holiday just that little bit more expensive, of course. But this latest decline coming on the back of the UPoll survey, talking about Scottish referendum, which is due for next week, and the first time YouGov has seen a positive move in favour of the independence vote, caused quite a wobble in sterling this morning. We've seen a 1% decline against the euro and against the dollar at the moment. And we've also seen some negative performance to companies that are associated to Scotland, companies like the Royal Bank of Scotland, for example, and some of the more traditional industrial groups. We're also off a little bit this morning on the back of that news. One sector that continues to drive higher is the technology sector, and this week Apple comes ahead with its important launch of the iPhone 6, and the talk is also that they're going to launch a new wearable device, which is a watch-based device, and that comes through on the 9th. So a great deal of anticipation for this new product. The hardware side of Apple's products certainly in need of a new product, so their expectation is that sales across the globe of the new products will be very strong on the back of this. It's a new form factor, new larger size phone is the rumour that's coming through, and most of the retailers are well positioned for this to be announced on the 9th. So as I say, that's important. It has driven Apple stock up to over $100, touching close to about $104 recently. So that's been strong, and one of our preferred recommendations, which I'm going to just flick through to whilst we're on the subject of technology, is Google. It has proved to be a resilient performer. It's really just hovering in that just sub $600 area, but one we continue to like at the moment. Just keep an eye on Facebook hitting new highs in the last week. So certainly it's a sector for me that continues to show very good relative strength. If we just go back a couple of slides, BP, just really an observation here on the BP stock last week. The surprise decision to see them as grossly negligent in the Macondo oil was caught the market on as I say, on surprise. They'd seen recently Halliburton settle their share and felt that as a result of that, the chances of a grossly negligent charge would be reduced as that. So it was quite quickly a disappointment for BP. In terms of fines, well, they haven't provided for a grossly negligent because they don't believe they are. So there's expectation they're provided for about $3.5 billion. And that fine could come through at north of $10 billion. So really the 6 or 7% decline we saw in the share price on the day was really almost 100% reflecting the level of additional fines that could come their way. Be aware though that BP will obviously appeal this, and this is a situation I suspect we'll still be talking about in 3 or 4 years' time. So this will be to some extent tried to be kicked into the further long grasp. Wanted to just make a quick observation on Ocado. We have got a recommendation on Ocado. There's no shortage of volatility in Ocado shares. Having caught them at around these sort of levels before, they had a very sharp run up to over £4 a share, but came back quite sharply. A couple of things weighing on Ocado. The first is, of course, the basic food retail space. Companies like Tesco and Morrison suffering. So they have been dragged down a little bit there with what's deemed to be slightly slower sales growth. There was also an independent research note out from an organisation that cut their price target quite dramatically, and it caught this company's shares sharply lower on the back of that particular note. But Wednesday we do have the trading update from Ocado. We do continue to reiterate our buy recommendation on that company, and we'll be reporting further this week on this business.